Hey folks, it's almost RSP deadline here in Canada and wanted to cover a few things about investing through an RSP in today's video. Hey everyone, Chris here from the Business Report Show. Before I begin, make sure to hit the subscribe button, and if you do end up enjoying the video, make sure you hit that like button. Every little bit helps. As a disclaimer, I'm not a financial planner or advisor, and everything I say in this video is just my opinion and for education purposes only. Make sure to seek a professional before investing. RSP, or Registered Retirement Savings Plan, much like the 401k in the US, is a great way for Canadians to grow their retirement savings in a tax-deferred way. RSPs were first introduced to Canadians back in 1957 and was really used to incentivize Canadians to save more for their retirement. There are great features about an RSP. First of all, money invested in an RSP can grow tax-deferred until retirement age, meaning you don't have to pay tax on your investment gains as long as it stays within your RSP. Second, the money invested into an RSP can offset your taxable income every year. So for many people, putting a certain amount of money into an RSP can be a good tax planning tool and may in some situations offer a nice tax refund at the end of each tax season. One thing I will note is you can invest up to the first 60 days of the new year into your RSP and use that for your tax filing purposes for the year before. So for this year, you can use this amount to invest in RSP up until March 1st, 2021 for your 2020 tax filing. Now, to dive deep into the mechanics and rules surrounding the RSP, I thought I would reach out to my good friend Eric, who runs his own accounting firm in Edmonton, Alberta, Canada, and is also a chartered professional accountant. As he deals with RSP related items with his clients at tax time every year, I thought it would be valuable to get some important RSP related information from a tax professional. Welcome to the show. Thank you for taking the time to join us today and lending your expertise on this RSP issue. So one of the biggest incentives for people investing through their RSP is, of course, the big tax refund or tax credit that you get at the end of the year. But because of this tax deferral and tax deduction mechanism, there are some limits to how much you can contribute to your RSP.
Assuming you have accumulated RSP contribution room, we can get into that in a little bit here. But basically, if you've been working, you've been getting a T4, you have a job, right? And basically, you are accumulating based on a formula of 18% of your employment income. There is a maximum to it. Nonetheless, though, let's say you've been accumulating that room for years and you didn't know about RSPs. And then this year, someone's going to watch this video and they're like, wow, I want to start RSP. And they find that they have $25,000 of contribution room in their RSP this year. Let's say that their income this year is $25,000. You would literally pay no tax because your taxable income, $25,000, would actually get completely wiped out by your RSP contribution, dollar for dollar. What I mean by dollar for dollar, if you made a $5,000 RSP contribution, you would get $5,000, a reduction of $5,000 in your taxable income.
From the tax credit or deduction standpoint, an RSP can be a great tax planning tool, especially for individuals in the higher income tax bracket. The amount you contribute to your RSP is the amount that gets deducted from your overall taxable income. So from a very simplistic example, if you made $100,000 and you had, let's say, room to invest $20,000 into your RSP, your effective taxable income for that year would actually be $80,000. So the tax you paid on the $20,000 difference would essentially be what you get refunded back to you. There are also other ways to maximize how you contribute to your RSP, such as making a spousal RSP. Essentially, you can make a contribution into your spouse's RSP to utilize their contribution room for tax-deferred investing.
Yeah, absolutely. So in some cases, let's say there's one person that makes more income than another person. That other spouse might not have the any enough income or any income to contribute to their RSP, right? So you could make a spousal contribution. Let's say I open an account for myself and my wife, and then I put a $5,000 RSP contribution into my account, and I could put a $5,000 RSP contribution into her account. This is sort of where the simplicity ends, though, in a sense, because some people think, okay, awesome. Then she gets $5,000, I get $5,000. Great, right? A lot of tax concepts, including this kind of RSP mechanism, traces income where it comes from. That $5,000 contribution I made to my spousal RSP is actually not deductible to her. It's actually back to myself.
One thing I will say when it comes to investing through your RSP is make sure it is the portion of your investing portfolio that is reserved for long-term investments. There are many penalties and deterrents for taking money out of your RSP early before you turn 71, so make sure you earmark this money for future retirement only if possible.
If you have a job, you are used to what having taxes withheld on your paycheck. I think it comes to a little bit of a shock for some people when they see their RSP account. Let's say they see a certain amount of money in there, and then they're like, I can use that money for something else. The thing is that there's actually a withholding tax that the bank or whatever the organization is that's holding your RSP, they will charge that so that you actually don't get the full amount.
Right. And then they would remit the withholding straight to the CRA?
That's right.
If I see that I have $10,000 in my RSP and I want to pull it out early, I'm not going to get that $10,000, all of it, because the bank or the brokerage is going to withhold the tax amount there. So just be aware that you're not going to get the full amount that you see in your statement.
Remember, you accumulate RSP contribution room every year, so you get a certain amount you can put into the account. Assuming that the stock market is always growing for you, you would want to keep that money in there as long as you could, right? But the thing is, once you take money out of that, let's say the $100,000 you take out of your RSP account, you don't get to put the same amount back in or anything like that. That room that you use to earn that up to $100,000, or the room you used before, that's gone.
Okay.
So it's quite detrimental.
Now, once you do turn 71, you will have to withdraw your funds, or you don't want to withdraw all your funds at once because of a potential big tax hit. You can actually convert it to a RIF, or a Registered Retirement Investment Fund, where there are mandated scheduled withdrawals every year from the government. Of course, once you do start withdrawing funds, you will be taxed on that amount that you withdraw at your tax rate. It does come full circle, with the government getting their slice of taxes back in return for giving you that tax refund earlier. Now, there are also other rules, such as you can't be day trading or be in the business of investing within your RSP, and you should be aware of some of these rules.
I can say that RSPs they can range. Generally, most people are going to think about RSP accounts, with the big banks or something like that, and then they will go find stocks that they want to buy if it's self-directed. Like if I'm in direct control, I log into my account and I click on stocks I want to buy, right? The thing is that, though, there are actually private investments. So let's say, Chris, you're going to build a mall, okay? I don't think it's a good idea to build a mall right now in 2021, but you're going to build a mall, and you're looking for investors, right? Those companies can actually make their investment RSP eligible. So there's criteria, and it's a complicated process. Legal process too of how things are structured. It's a risky idea, and I would agree. But then you can tell me, but you're going to get that tax refund because it's RRSP eligible. Now, there's nothing really wrong with that. That's completely legitimate. But the problem is that there are ways that I would say some schemes out there have structured the returns and how they use the RSP mechanism to essentially put you at risk, the investor at risk. Those schemes have basically made the CRA sort of take a harder look at what people are actually doing with their accounts. And the other thing is that if you're sort of day trading in your RSP account, it could get you in trouble because RSP accounts are typically not supposed to be used for business. CRA is definitely not in the attitude of providing you a tax-free environment to grow your day trading account, right? When it resembles business activity, what business activity would be, let's say like day trading, just a pattern of trades and type of trades, like high-risk trades or whatever else there is, right? Like essentially you're running a brokerage. You're taking money from your friends and family and investing inside your RSP or whatever it is. That will get you offside too.
For those who haven't set up an RSP account before, you can do it at any financial institution, as well as some of the discount brokerages which you may be using to make stock trades online. Well, Eric, thank you so much for taking time out of your busy schedule for providing us a little bit more in-depth insight into the whole RSP process.
Appreciate it.
Well, that is it. I just want to thank Eric for taking the time to join us in this video. I know he's ramping up for the busy tax season, and I probably won't see him surface again for the next couple months. Don't hesitate to put your questions about RSPs down below in the comment section, and I'll try my best to find the right answers for you. Thank you for watching the Business Report Show. Remember, always be learning, always be investing. I'll catch you in the next video.